Welcome guys to a video on a stock I've been dying to talk about, which is Fubo TV. Over the past couple months I've been seeing Fubo this, Fubo that, with Venue, various speculations like being bought out or going bust, but recently I feel like this stock has gone a bit quiet. So today I want to talk about my opinions on this stock and where it might be heading over the next year. Just a reminder that this is not investment advice, just my simple thoughts on this exciting stock. So what is Fubo? Alright, so Fubo TV is a live TV streaming service aimed at people who want to ditch traditional cable. It's especially great for sports fans, like that's their main audience, but it also has plenty of other entertainment and news channels. One of the big perks is that it's super flexible. With cable, you're stuck with contracts, hidden fees and equipment rentals. Unlike cable, there are no contracts, so you're not locked into anything. You can tweak your plan, add channels or even cancel if it's not your vibe. Plus, you can stream it on pretty much any device, your phone, laptop, smart TV, whatever works for you. No clunky cable boxes or installs required. I feel like this is pretty obvious, right? It's odd that people might still need to do this in today's economy. Everything should be flexible and easy, or someone else will be. So, for cool features to stand out, Fubo has a couple. Firstly, it has cloud DVR, so you can record games or shows and watch them whenever you want. It supports 4K streaming and has this cool feature called multi-view. This allows you to watch up to 4 channels at once. This is great for someone like me who struggles to choose between Premier League soccer games here in the UK. They're all being shown at 3:30. Like, come on, this is a must. Fubo also has different packages and add-ons, so you can customise your plan depending on what you're into. Whether it's international sports, premium movies or extra channels, you've got options. And again, no contracts, so you can make changes whenever. It's also a lot more sports focused than most cable packages, and it partners with major leagues and broadcasters to keep that content flowing. Whether you're into local teams or international events, there's something for you. Okay, I'm done with the speech. I feel like there's so many creators that talk about how great a company or stock is, but for anyone new, they have no clue what the company even is. Now, why am I interested? The reason, funny enough, in why I'm interested in this stock was almost the reason why the company nearly went bust, which is Venue. I feel like a lot of people are seeing this as a problem, when in actuality it's the best thing that has happened to Fubo. So why do I think that? So 3 massive companies, ESPN, Fox and Warner Bros, have come together to make a competitor to Fubo called Venue. They would have been able to sell a skinny bundle package that Fubo have wanted to do for years. Why pay like $80 when you can watch all the channels you wanted to watch for half that? Now, in my opinion, if 3 major companies are coming together to form a company to sell streaming services, they need to be convinced that they are going to make a sizable profit shared 3 ways to make it worth it. So clearly, in their eyes, this is where the market is going. And they are trying, so far failing, to get into it. And this is what 3 major companies see a large portion of the market going. That's a great sign. It's also a bonus that Fubo managed to stop them with the preliminary injunction in August. Now the next trial is set for October the 6th, where Venue is going to try to overturn this injunction, so we'll see then. But for the injunction to get overturned, Venue will have to show some legal arguments that I just don't think it already has, and would have shown in the previous trial. Venue will obviously kill off all competition, and then do the next obvious thing, raise prices. And as there are no other options, people will have to pay it. This isn't like watching films or streams where you have Apple TV, Netflix, Amazon, Disney and so many more options. It will be either Venue or nothing, which would be a massive decision for the court to say that that's not anti-competitive behaviour, especially as they have been purposely not allowing Fubo to have skinny bundles for years. And the first thing that they're advertising, you guessed it, skinny bundles. So if Fubo sends Venue to the grave, the next thing to look at is a possible fat check for legal fees and damages, like the fact that Fubo probably wasn't able to spend as much money as they would have liked on advertising, as they're putting it all into the court case. Anyway, so that's the business model and the main threat, which I believe to be a positive in disguise. So looking at Fubo's big stats, so that it has 1.61 million users, 378,000 paid subscribers and $377 million in revenue in the last quarter. And this is only getting better year on year. Looking at Fubo's subscriber growth, it is almost 3 times the user base since 3 years ago, which is about 19% year on year growth. Now you can see it always dips down quarter 1 or quarter 2, which is due to the end of the football season, which is the beauty of the product though, right? People can start and stop whenever they like, but look, most people will still stay. If you want to listen to this piece, please do. I'll probably yap on for the next 5 minutes about assets, profits, or in this case losses, and stock dilution. So if this isn't how you trade and you prefer the more YOLO route, skip this part. I'll talk about more vague nonsense soon, like my stock prediction after this. I feel like it'd be helpful to explain the balance sheet to you lovely folk. So just a reminder, this is in thousands of dollars. Like it's 146.175 million, not 146,000. So with current assets, these are assets expected to be converted into cash or used up within the year. The cash and cash equivalents decreased from 245 million to 146 million. A decrease in cash probably indicates that Fubo spent more cash on operations, investments, or paying down liabilities, or possibly the venue court case. I say no worries here. For accounts receivable, these are amounts owed to the company by customers. It's slightly decreased from 80.2 million to 76.8 million, which may suggest either a decrease in sales or a change in the collection timeline, which one of the things that worries me slightly. Prepaid sports rights. This is money paid in advance for sports content rights. It decreased from 40 million to 36 million, which could just indicate the company utilised or consumed some of these prepaid rights. Other current assets, this category represents various short-term assets like inventory or short-term investment, which decreased from 21 million to 20 million. Assets of discontinued operations. This represents assets associated with parts of the business that are being shut down. The reduction from 462 to 391 reflects a slight reduction in the size of discontinued operations, which is great. Total current assets decreased from 386 to 278, which could signal a reduction in liquid assets or short-term resources. Now for the property and equipment, this increased from 4.8 to 5.6 million, suggesting the company may have invested in new equipment or assets. For restricted cash, this is cash the company is unable to access for operational use, which has remained almost the same, about 6.1 million. Intangible assets. This decreased from 158.4 million to 139.8 million. This could include things like trademarks, copyrights, and licenses. This decrease might reflect on intangible assets being used up or expired. Nearly done. Goodwill. This remained relatively stable at 624 million compared to 622 million. Goodwill represents the premium paid for acquisitions over the fair value of the acquired company's net assets. The total assets decreased from 1.2 billion to 1.1 billion, reflecting a drop of $130 million, which for a company which is supposed to be growing isn't as sparkly as I'd like to be. But a company shaving money on assets to increase profits isn't always a bad thing. Once they tip into being profitable, that's when I assume their assets will grow. Now, I'm going to vaguely skip over liabilities because it's boring, and no one really cares, and if you did, you'd probably have researched it yourself, but it boils down to the following. Current liabilities saw a decrease, which, with notable changes like a reduction in accounts payable, they paid down some short-term debts, an increase in deferred revenue, more payments received for future services, and a decrease in liabilities of discontinued operations, reducing obligations tied to operations they've stopped. Now, current liabilities decreased as well, with a drop in convertible notes, possibly paid down or converted to equity, and lease liabilities, reduced ongoing obligations. Although other long-term liabilities saw a small increase. Overall, total liabilities dropped, suggesting the company reduced its total debt and obligations. Now, shareholders' equity. The company issued more shares, or diluted current shareholders, increasing additional paid-in capital from 2.13 billion to 2.2 billion. Accumulated deficit grew from 1.85 billion to 1.98 billion, indicating continued losses. Non-controlling interest increased slightly from 11.75 million to 13.21 million, suggesting changes in minority ownership. And accumulated other comprehensive income rose from 4.22 million to 4.65 million, reflecting small gains. Overall, total shareholders' equity decreased from 283 million to 222 million, driven by the higher accumulated deficit, and other changes. So, in summary, the company has seen a decline in both assets and equity, with increasing losses contributing to a larger accumulated deficit. However, it has reduced its liabilities, particularly long-term debt, which could indicate efforts to stabilise its financial position. Okay, now revenue is slightly more interesting, I promise. In Q3 of 2024, the company made $386 million in total revenue, up from $320 million last year, so that's a nice boost. The big contributor here is subscriptions, which jumped from $289 to $356 million, which is a solid increase. Advertising revenue, it actually took a bit of a dip from 30.6 to 27.1 million. But if we look at the year-to-date numbers, we see a slight growth from 76.4 to 80.8, so some positive movement there overall. This follows my assumptions that money is being put into legal battles rather than advertising. Now, let's move on to operating expenses. These have definitely gone up. They went from 404 million to 444 million, and year to date it went from 1.18 billion to 1.34 billion, so not exactly a small increase. Some of the bigger jumps include general and administrative expenses, which went from about 15.9 million to 26.5 million, and technology and development expenses, which jumped from 17.5 million to 21.2 million. So they're clearly investing more in growth and operations, which is also shown from their increase in assets on the property and equipment section we talked about earlier. Despite the higher expenses, the good news is the company's operating loss improved. It went down from 83 million to 58.6 million, and for the year to date it dropped from 217 million to 157 million. So they're still in the red, but things are getting better. Finally, the net loss. So even though they're making more money and cutting down their operating loss, they're still in the red. The net loss for Q3 was 52.8 million, which is an improvement from the 83.8 million. And year to date, it went from 217 million down to 135 million. So definitely some progress, but still a way to go. So all in all, there seems like a mix of positive revenue growth and some big cuts in their losses. But there's still lots of work ahead to turn those numbers around fully. What do you think? Do you see any improvements coming? Please let me know your thoughts in the comments below. There is talks about the company having a profitable quarter next year, but this is strict by the numbers section, so I'm going to keep to hard, cold facts at the moment. One last thing to talk about is net loss per share. This decreased from a loss of 29 cents per share to a loss of 16 cents per share, which is great. Another decrease like this and we'll be in the positive. Sorry, I'm speculating again. Anyway, my main takeaways from this is that we're heading in the right direction financially. A main worry of mine is Fubo's need to dilute stock to raise funds. They'll keep doing this until they become profitable, but as a current stockholder, cat's out the bag now. I don't like it. Now comes the part where I say a load of rubbish technical analysis. So the stock took a pretty hard turn this year in January, February time, as the news of the new Fubo competitor Venue came out. It dropped from about $3.25 to a measly $1.20 in June of 2024. I believe that until the company becomes profitable and Venue stopped fully, the stock will range between $1 to $2. There is no reason for it to go any lower or higher, as it has an abundant potential but could also go bust. So that's how it's priced, a company that is going to go bankrupt. But once Fubo shows it is capable of having a profitable quarter, this stock could really bounce, at least to the $3 range it originally fell from, which is my sensible prediction for December next year of $3. It obtains a profitable quarter and beats Venue, which I guess is a tall order, but I'm a believer. Okay, so let's talk about what's coming up next for Fubo that might actually move the stock price. First off, the October the 6th court case with Venue is a big one. If Fubo keeps the injunction in place, that's a massive win against three entertainment giants trying to muscle in on their turf. But if it gets overturned, yeah, not ideal. Either way, some serious stock movement in the coming around that day. Next for Q4 earnings, Fubo's management has hinted at the possibility of profitability next year, but the Q4 results are going to tell us if that's a pipe dream or a real possibility. This is where we'll see if their subscriber growth holds strong through the NFL season and if their ad revenue finally picks up. Oh, and don't forget the sportsbook angle. Fubo's dabbling in sports betting hasn't exactly been a slam dunk so far, but if they can find a way to integrate it better with their live sports streaming, it could be a game changer. Finally, watch out for their partnership announcements. If Fubo manages to team up with major sports leagues or networks, or even land a juicy licensing deal, that could send the stock flying. So yeah, lots of catalysts on the horizon. Whether you're bullish or bearish, it's definitely not going to be boring. This is the first video I've ever made. It's as if one of you decided to make a couple Googles, write a basic script, and record your voice on a broken iPhone, because that's what I've done. So if you have any constructive criticism, please let me know. But telling me to go kill myself also works, so thanks for listening. One more thing, please let me know your stock predictions for Fubo in the comments section. If you could write why as well, I could review this in my next video on Fubo in the future.